Hello and welcome. Thank you very much for joining us today. My name is Mark McCarron. I'm the Chief Investment Officer here at Wescott. And we wanted to give you an update on what's going on out there from our perspective in the economy, the markets, and how it's impacting your portfolio. So we've entitled this presentation, Stability in the Face of Uncertainty, which there has been plenty of uncertainty out there in the markets. And we wanted to highlight a few things that we think are important and go forward with our outlook. So let's just jump right in. We'll start with the second quarter date return, which is in orange, and the year-to-date return for key asset classes in blue. All but two, if you will, are above for the quarter, and all but one are above for the year-to-date period, which is a very good result given all the uncertainty around tariffs and trade policy and a new administration coming in with quite a lot of moving parts. Non-US markets continue to benefit from a shift in leadership. The US dollar weakening is a big driver of that. In fact, it explains about half of the return that we see in non-US and emerging markets. They remain attractively valued, and we see improving growth there. So all of that is really why we've seen such strong results outside the US. Within the US, we saw a rebound in artificial intelligence and technology. Demand for that continues to be significant. It's driving great returns within the technology sector itself, but also the supporting industries, such as the data centers around the country that are in high demand to facilitate growing AI and technology needs. We have both of that exposure in your portfolios today, and that's been a very good performer. If you look at the infrastructure line item here, it's been one of the best performing sectors of the year. And then small cap stocks, they are more economically sensitive. They had a great quarter, but they also had a tough start to the quarter. And a lot of that has to do with some of the themes we'll talk about shortly. But before we get into the big themes, I wanted to highlight really an important lesson, something that we've always followed here at Wescott is staying invested despite some of the uncertainty and the headline risks. The first half of 2025 was very volatile. You can see that in this chart where we show a performance of each major sector for the year-to-date period, but we also show how far it fell during the period. So, for example, developed market equity here outside the US fell 15% at one point, but finished the quarter nearly up 20%. The US stock market was down almost 20%, 18.9%, but actually, ended the year-to-date period up 6.2%. So those are significant drawdowns, but you can see that within a very short period of time, they recovered. And I think it's a great reminder that investors who stay invested, and that's our recommendation, stay invested, that they, that exposure, that approach, that pays off over the long run. And so we wanted to highlight that today and really show the value of that staying invested. So we're not out of the woods yet. Of course, there are a lot of puzzle pieces still to be considered. Trade uncertainty remains. We're in the middle of July, and some of the tariff announcements have been postponed yet again. All of that brings less clarity to business leaders, to investors, to consumers, and could result in more volatility. We'll get to that in a moment. The unrest in the Middle East that we saw during the quarter was significant, and that has the potential of disrupting and bringing volatility back to the markets. Interestingly, we didn't see that in the energy market in the second quarter, but that's not to say that won't show up going forward. We talked about the US dollar weakness. A dollar declined by about 10 or just over 10%. That's a good thing for the non-US exposure of the portfolio, but it does reflect some concerns maybe by global investors around US policy. And speaking of US policy, the big beautiful bill was just passed just at the end of the quarter that has implications that go beyond investing, of course, but if you look at tax policy, if you look at what that might do to the debt of the U.S., all of that is out there bringing some uncertainty, and with uncertainty, we see volatility. And the spikes in volatility is best seen, we think, by looking at the underlying volatility index. It's called the VIX index of the U.S. stock market. And it's often when it spikes, it's when investors are feeling uncertain or nervous. And the last time it spiked above 50, which is where it is today, or was in early April, was back during the pandemic, and prior to that during the financial crisis. So two very significant periods of declining equity markets. And we saw a glimpse of that here at the beginning of April. Interestingly, though, as we sit in July, more talk of tariffs being placed on international trading partners, we have not seen that same spike. So we want to be thoughtful around volatility. We don't want to react to headline risk. And if you try to time the markets, you're often worse off than sticking with it. And that's why we want to highlight this great quote. Peter Lynch, American investor, portfolio manager for Fidelity Magellan Fund: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So a great reminder of staying committed. And that's why we're here to help you through those periods of volatility. So going forward, I think the Fed is also thinking about what might come next, and they're considering the same factors that we just went through: trade policy, geopolitical risks, the dollar, and the impact on inflation and on the labor market. So we start first with the labor market, and the unemployment rate has remained relatively steady around 4.1%, and it's relatively healthy. There are signs maybe underneath of some weakness, but in general, the Fed is looking for full employment, and we have relatively full employment here. And that's, again, the Fed's not going to move very quickly here until something happens in this measure. So let's look at inflation. So inflation measured by the Consumer Price Index has declined from its peak during the post-pandemic period. It's fallen below 3%, but is still above the Fed's target of 2%. That is a key factor in the Fed's math in terms of what they're going to do next. The final point I'd make is that they've been steady. If they remain patient despite pressure from the White House to cut rates, and it's because of that uncertainty that you just talked about. They're not likely to cut rates until there's some clarity around what those policies might have in terms of an effect on the labor market and inflation. Right now, inflation expectations are rising a bit, and they want to be thoughtful about that. So I think the future Fed policy will depend on what the recent trade agreements result in terms of tariff rates, and also the details of the latest tax and spending bill. So more to come there. So what do we do in this situation? I think we want to highlight three areas. The first is maintaining balance in the portfolio, which is really a key component of what we do. But we want to try to manage the interest rate sensitivity within the bond portfolios very specifically, because that's where tariff and big beautiful bill and other things could impact rates and inflation. And that's probably the most important part of what we're trying to do, is manage that sensitivity within the bond portfolios. The second is to make sure we remain globally diversified. A huge help to the client portfolios this first half has been diversifying globally, benefiting from earnings growth and also currency diversification. And then finally, thinking about allocations outside of the core portfolio, maybe alternative investments that generate income, could be a nice complement to the core portfolio. So with that, we very much thank you very much for joining us today. Thank you also for your continued confidence in Wescott. Please do not hesitate to reach out to me or your advisor if you have any questions whatsoever. And please do follow us on Facebook, on LinkedIn, and on Instagram. Thank you.